Okay, good afternoon, ladies and gentlemen. I'm happy to see all of you here, and I hope that you are having a productive summit. We are just about to start our second panel of the day, a panel about multi-asset trading. I'm going to leave the stage for our senior editor, Mr. Ron Finberg, who will present the premise of the panel, and then he will let the distinguished panelists present themselves. So enjoy the discussion.
Thank you very much, Aris. Okay, so the big question is, everybody knows we were Forex magnates and then we became finance magnates. Part of that transition was that we began to cover a lot more in other asset classes, more than just the foreign exchange market. So part of that migration is that we felt it was important for our readership and just for our better understanding to incorporate this multi-asset panel for more education at the summit. So I appreciate everybody's here, and I appreciate our panelists, and I'm looking forward to hear what they say. So before we start, if everybody can just start with you, Christian, just a little bit about your background and just what your company has to do with multi-assets. Go for it.
Sure. My name is Christian Hammer, and I look after the trading platforms in Saxo Bank. We started out in FX 20 years ago, but have gradually evolved into multi-assets. So now you're able to trade everything from ETF, cash stocks, futures, options, bonds on the platform. So we do have a true multi-asset platform available to our direct clients and our white labels.
Hi, I'm Joe Conlon. I run FX sales at FC Stone out of New York. FC Stone is an international company that, beyond FX, offers commodities, futures, equities, and I think some of these other asset classes that will make interesting talking today.
Hi, Brandon Mulvihill, FXCM, been with the company for 10 years. I manage our institutional department, and I think today what I'm going to be focusing in on from the FXCM side is really the evolution of FX trading and maybe some of the inefficiencies that are still left today in the CFD market and how we can maybe patch that up.
Hi, I'm Cyril Tabet. I'm the partner and chief executive officer at the JFD Group. JFD is active in three, let's say, divisions. There's JFD Brokers. It's a retail OTC brokerage. We have JFD Prime, which is providing prime of prime services to other brokers. And we have JFD Wealth, which is active in the asset management. So we were, I guess, the first MT4 broker to launch a multi-asset class offering within this platform. So we have, obviously, the FX, the metals, the indices, equities, commodities, interest rate, inflation rates, ETFs, etc.
The whole gamut.
The whole package.
Sure.
And we've been managing to grow significantly our business thanks to that. So I will share why and how we've done that.
Okay. We'll hear more about that in a second.
Good. I'm James Watson. I'm the managing director of ADS in Europe. I'm Australian, and whatever they do, we do slightly better. Too much? Too early? ADS has been around for 5 years. In London, we've been around for 1 year.
All right, so do any Americans here can do the GOP debate?
I'm on stage. I'm ready to go.
Hopefully today I can contribute to the presentation and we all go away with some consensus. Thank you.
Okay, thanks everyone. So I want to start with something that's a little bit like a current event type of situations going on. In several of the past conference calls from Interactive Brokers, I don't want to bring a competitor over here, so their CEO has been mentioning that even though they're not a prime broker, they're still being able to gain a lot of interest from hedge funds and asset managers that are making decisions, because of a contraction in prime broker relationships and people are offloading prime accounts, maybe they'll just start working directly with the broker instead of having those relationships with the prime broker. So I wanted to kind of get the idea of what's the benefits of using a prime broker or going straight to a multi-asset broker. Maybe start with you, Christian.
Well, I think if you are a hedge fund or a family office or whatever, and that's mid-tier segment are no longer being able to be serviced by the tier one bank due to size and other things, you want to make sure that you get most out of your capital. You make sure you want to get most out of your back office operations. So going to like a multi-asset provider, like the guys who are represented here, will give you a lot of operational efficiency. And I think at the end of the day, this is really the benefit that we bring to the market, to the space. The consolidation on the back office operational and the get most out of your capital, not having to post capital with multiple prime broker setups.
And James, I know your opinions on the PB space.
I think that everybody's aware that the whole PB space has gone upside down. I think that the most important thing for your client is that they get the most from their PB relationship. So if they are going to have a PB relationship, you have to share with them that they've got to get the best use of the capital. And in doing that, then they can be serviced properly. In a case of ourselves, we see a gap in the market. We see the fact that being able to start our own prime of prime, leveraged off the back of our very large balance sheet, we can go to clients and have different conversations. So I expect what he was saying in his meeting is that the world is changing and you're going to have different relationships. And some of those relationships can be via enhanced one-to-one. They can be through principal trading. They can be through use of prime. But let's not forget, it's the client who's going to define what they want. And what we have to do as a group is match ourselves to those clients to give that client the best use of their capital and the best use of the product.
Joe, I want to hear what you think, because you're the participant who doesn't have any retail customers, or you have some big traders, but mostly.
Yeah, FC Stone doesn't face any retail clients. We only deal with clients that are eligible contract participants or professional clients. But we're seeing enormous growth in this space for the need for prime of prime. A lot of that's off the back of some of the major primes pulling back from their offerings. A couple of years ago, some of the major primes started taking clients with balance sheets as little as $5 million in net equity. That actually cut into the top half of our target audience. Those people have now reversed that, and that's really opening up the door for a prime offering, which can almost completely replace the prime offering at different price points and also different terms.
Brandon, what do you think?
Yeah, I think James said something a couple of times in efficient use of capital, and I think that really is, that would be probably one of the slogans, one of the bullet points that has to be hit upon. I think the most important thing, just looking at market structure, is from the banking side, the big three prime brokerage units that they typically run are equities, fixed income, and FX. And in the equity market, if you look at the top 5 guys, you're talking about guys where the top guy does $2 billion in revenue. The fifth guy is somewhere between $500 million and $1 billion in revenue. On the FX side, it's a very different ballgame. The top guy is doing maybe $200 million in revenue. The fifth guy, maybe $40, $50 million in revenue. And so I think the big thing that's happening right now is that the tier 1 primes have just vastly underpriced the market. And so what's happening today is that you're seeing that there's this recalibration where people are saying, listen, if I'm going to tie up this capital, we need a return. And I think when we think about prime of prime, we have to be very specific. FXCM is currently offering FXCM Prime, but when we think of FXCM Prime, what we think of is a user who's going to have multiple execution hubs. He's going to trade on CurrentX, he's going to trade on Hotspot, he's going to trade on FXall, he's going to trade on FastMatch, and all those trades are going to settle with clear with us. And so we obviously charge just a clearing fee. When you're looking at someone who's doing multi-asset, what's interesting there to a lot of people who are doing multi-asset is that they can give the person one execution hub, which is their own, and monetize the execution piece, which then they can subsidize the prime broker cost for. So in foreign exchange, if your clearing charge, let's say, is $5 a million, you need a lot of turnover. You don't want a lot of NOP usage overnight. Versus if you're actually executing it through your own execution hub, you can get away with $10, $15 a million and just call the clearing cost as something that's wrapped up into your execution.
Okay. Just a quick raise of hands in the audience. How many people are coming from the retail broker part of the industry? Okay, so There's quite a few. So moving on over, I wanted to kind of...
Ron, maybe I wanted to add
I'm
something.
going to get into these.
Okay.
So I want to move on to what's an important item for many of the people, attendees, is, you know, they're a MetaTrader broker and they just want to add CFDs. So I want to kind of hear from the panelists what do they need to be doing in order to, you know, operate their CFDs and their multi-assets efficiently. So because your setup, Cyril, is very similar to many other brokers that are here. How are you handling it?
Okay, thanks, Ron. But I still would like at some point to discuss something about the asset management.
We ought to keep it to an hour, you know?
Okay. Right. I think when it comes to add CFDs into a brokerage environment, it's quite difficult because when you look at the FX side of the business, I think, first of all, it's standardized. I mean, you have, you know, aggregators, you have the banks. I mean, they're pricing the same thing. With the CFDs, it's different. Everybody has a different pricing, different ticket sizes. It's really not aligned. The second thing is that on the FX side, there's a balancing that is done between the institutional side of the market and the retail side of the market. So for a bank, a tier one bank, that will have an exposure to the institutional side, it's interesting for a bank to have an exposure also on the retail side because you all know that when the institutional side goes long, the retail goes short, and the bank can kind of balance its exposure there. So they have a lot of interest in capturing retail trades or retail flow from the retail market on the FX side. The other thing is that the banks are very much interested...
Let's keep it on the question.
But it's important to see that there's the added value liquidity or the shortage of liquidity. When a bank is facing an institutional client with a big ticket size, maybe on the market there's not enough liquidity available. They can source it from the retail side of the market. With the CFDs, it's really different because you have players, historical players, that are not facing the institutional side. They're just facing the retail side. So there's no rebalancing to do. There's no redistribution to do. So the CFD market is much more sensitive, let's say, to the P&L, to the retail flow of your clients. So I think one of the most important thing when you want to develop, let's say, a CFD division, it's to understand how to connect to the CFD flow and how to integrate it. So the integration, these days, we manage to fast track this. It's easier and easier. There's more and more bridges that have the capacity to support CFDs. Platforms, it's getting there. The MT4 can support this. The C-Trader, some others, Tradables are working on it. But let's say the choice of the CFD liquidity provider, I think, is a key choice. And I would always recommend to work with a prime of prime that has different CFD liquidity provider, a real pool, that has been spending the time to align all these liquidity providers, and that will limit your exposure to one liquidity provider that could be ultra sensitive to your retail flow.
Okay. I want to go back to a couple of years ago, James, when you were on one of our panels, when you were representing the FX world. So one of the things you mentioned back then is that when you deal with customers, you first find out what their problems are, and then you want to, solve those problems. So when it comes to, you explained back then how you solve that with the FX world. What are the problems that brokers are experiencing, and how are you solving that with CFD liquidity?
I was talking to our CTO just before this, Andrew Rossiter, and we were just talking about the fact that when it comes to CFDs, the source of liquidity becomes extremely important, because the fact is, can you hedge your risk? If you can't hedge your risk, you are, to quote a famous philosopher, screwed. And a lot of people like to hold illiquid stock. So before you price that, before you put it out to the market, you've got to know you can cover that. So therefore, a CFD becomes interesting in that point. But again, it comes back to knowing your client. It's the drum I always bang. If you know your client, so for example, we just recently were involved in the whole Ferrari thing. We sold tons of CFDs on Ferrari. But the thing was, the hedging wasn't as bad on that because people want to hold it. it's a Ferrari. Ooh, it's red. I'm going to hold it. You get a nice stock certificate, or you get a nice, I'm holding that. So the risk to our company was much lower. So back to your question is that I think that the source of liquidity, does it need to be what I call prime liquidity, in the sense of, if I'm dealing with an institutional client, I am going directly to the exchange. Why? Because I can be arbed. Those guys are multi-second, all that, multi-millisecond. Whereas if I'm trading with something that is a retail person is maybe not as aggressive, then I can use BATS or Reuters. But I've got to build into my pricing latency. Does that answer your question?
Yeah.
Good.
Christian, what do you believe?
Yeah, I think there are 2 points that I'd like to make with respect to the CFD and moving from FX into the CFDs. And of course, I was touched upon the ability to actually have a solid relationship with your back end, with your broker is much more, or is very important, and it's more difficult to get than it is for FX. You want to make sure that you have somebody that is backing you, where you can actually offer your clients shorting, so that you need to actually borrow the stocks and stock lending and so forth for the hedging part. And also for us, at least, the CFD offering goes very much hand in hand with the underlying stock offering. You want to be able to provide the dividends, the corporate actions and so forth on the CFDs, on single stock CFDs, and in the indices that you have in the underlying market. And that does require quite a big effort on the back office to handle all the corporate actions, which is very different from FX.
Brandon, just touching a little more on them. FXCM has been in position where you've been adding slowly different single stock CFDs, and kind of because of your agency model, so it's a little different. But how does the whole hedging process work for a CFD broker?
So if we're talking about share CFDs, so on the equity side of it, to be quite honest, there's a number of different routes that you can take, including a DMA solution. In the equity space, from a market structure standpoint, there's a lot of different ways to do that. That infrastructure exists. What I would focus on, what FXCM is interested mostly in, are the index CFDs and some of the commodity CFDs, such as oil. And I'll give you an example, right? If you look at the largest CFD broker on the planet, right? I'm not going to name who that is, so we don't need to get in a debate on that. But they will show you in their annual report, they do roughly 2 million trades per month. FXCM does 550,000 trades per day, right? And what does that actually mean, right? What it means is the first guy is clearly a CFD broker. The second guy is clearly doing a lot of foreign exchange. Why? Because in the foreign exchange market, what happened years ago, right, is you have 3 effective market makers. You have the broker market maker, which measures profitability in the lifetime of the trade, right? Customers are trading, they take a risk book, and then they manage that however they want to manage it. But you can also aggregate, as many people do, and you can give those trades out to a bank market maker, and he measures his profitability in about 3 to 7 milliseconds, which means if you have an automated trader or a black box trader in the retail market who wants to trade in and out for 5 or 10 minutes, for any market maker, from a broker standpoint, FXCM standpoint, difficult to manage that flow. He's creating noise every 5 to 10 minutes. But in an aggregating environment, to the bank, he doesn't care, right? Because all he cared about is what happened in the first 3 to 7 milliseconds. He doesn't care what happened 5 minutes later. And HFT, which has become more prevalent these days, looks at 1 millisecond and sub 1 millisecond. So the point is, why is FXCM doing all of these trades, right? It's because the retail market, through passive means in an automated platform, or in some cases directly via an EA or an API, is doing a lot more automated trading than he is on index CFDs. And the reason that's the case is today, because there's no prime broker in the index CFD space, there's no market structure to aggregate liquidity. And this is something that we're looking into, and I think this is a big area that we could all improve on within the marketplace, to try to basically get the retail consumer into doing more automated platforms and having more availability within the market, within that product range.
Okay. Joe, just to hear what you're saying, what you believe when you talk to clients about how to hedge their risk on the CFDs.
We get a lot of retail brokers that come to us and want to open up futures accounts. They then are able to access all the market data that they would need in order to have a full body product offering. Then they would use, it seems that some of these guys are taking some B-books positions in between, but then they're hedging out to a round contract. So they're always going to have some position because their clients aren't trading round contract amounts. But in the business model that they've built for themselves also is enhanced by the financing or the rolls, the daily rolls, whereas the futures, which is their hedge, you've got a one-date delivery. So there's some very good money to be made in between there. What they look for from guys like us is some automation to being able to attach to FC Stone as a futures commission merchant, so they can get the data automatically and then take off the risk as they wish.
Okay. Cyril, coming back to you, you mentioned touched on a little bit about different data providers, but you mentioned that you believe it's best to have a single one to deal with. So how did you make that decision? Like, are you using one single data provider per asset class, or across the board of your products?
No, so I didn't mention that it's better to have one provider. What is important is to have, let's say, the same pricing across the board. As Brandon said, there's no such thing as an aggregation of CFDs. But what is important is to be able to deal with different CFD market makers, to limit your exposure to any type of risks. If one would go bust, and we've seen some things happen with the CHF event, you would need to find another one very quickly. It takes time to integrate all these. So I think it's very important to have a multiple, let's say, liquidity pool for the CFDs. And the real difficulty is to align every single one of them. The only way to do this is if you're waiving enough on the market, if you generate enough volume, if you're interesting enough for every single one of these CFD market maker, they will take the time to align their offering to your requirements. So that's why it's very difficult for a new broker who says, okay, I want to launch CFDs, I would like to add a little bit of diversification or whatever. They don't wait enough to go and say, that's exactly what I want. They will be obliged to work with one provider, and there's always a risk there. So that's why a prime of prime for a CFD liquidity provision offering is always the best way to start and to sustain a business over the longer term, because you're benefiting on economies of scale. Your prime broker on the CFDs has a better deal with the CFD market maker. So would that be a higher rebate on the spreads or a better P&L deals? So any of his client will benefit from a better deal. At the same time, he weighs more in the term of guaranteeing best execution. So, if you generate a lot of volume or you're a good client, you're going to request for some service level agreements. Let's say you'll say, I really want my clients to be executed. Imagine one thing, when I was discussing that a CFD liquidity provider...
I want to move on to the next one you want to talk about.
Okay.
Okay. Did you want to add on that, Christian?
Yeah, I think at least going into CFDs is just not a question about adding another, you can say, instrument type. At least in our view, the CFD is only a wrapper for an underlying. So what is it you want to wrap? Is it FX spot? Is it a commodity? Or is it some equities, either index or single stocks? For us, if you go into the CFDs to differentiate your Forex business, you are actually entering into the equity space for the CFD, single stocks and indices and so forth. But will that really allow you to differentiate significantly? You will very quickly also meet demands from these type of clients being able to offer the underlying stocks, maybe even the options, making sure that you can use the underlying stocks as collateral for your CFDs positions. So the CFD is just a wrapper to get into a market. So if you want to enter the equities market with a CFD, you will very soon get a pressure from your clients to offer a wider offering. At least this is our learnings.
Okay. I had a question, though. If you're using multiple providers for CFDs, if the client trades, he buys on one and sells on the other,
Okay, so this currently doesn't work this way, obviously, because the CFD market maker wants to see both sides of the trade. So you're going to allocate a group of client to one, a group of client to the other. Then you can switch them. I think that now banks are starting to look at CFDs. I mean, we see banks that are attracted to this activity. The way they work is either they will completely hedge themselves on the future market, that's fine, but they're also interested in providing a synthetic execution where they will price it tighter, but they will take all the risk. And at the end of the day, let's be honest, if you're a sophisticated trader, you'll trade futures. If you're not a sophisticated trader, you'll trade CFDs. And typically, the CFD trader will end up losing at the end of the day. So the banks are also interested in that. And I think step by step, we will get to a more mature CFD market. I think so.
Okay. The next question, one topic that's been coming up more often lately is distribution rights. So every exchange has the CME, so they offer the crude oil and the S&Ps, and so every exchange, like they own the pricing of that, and there's fees you have to pay to distribute that pricing. And we know that there's a lot of brokers aren't paying those distribution fees in order to price those products for their CFDs. So I just wanted to know, but the CME has gone after a couple of brokers about this. So I want to know from maybe Brandon, you can a little bit explain about that process, and is this something that people should be more aware of, or just kind of winging it for a while?
No, I would strongly advise no one wings this. Seriously, this is a multi-billion-dollar industry, right? The CME generates between $350 and $400 million in market data fees. ICE is similar. Eurex slightly smaller. ICE, in fact, people probably saw just bought IDC, and from that purchase, which, by the way, was $5.2 billion, right? And they didn't do that to lose money, right? They've actually have come out and said that they think they're going to double the amount of revenues they generate from market data fees, which takes them to roughly $700 to $800 million. And so the one thing I can say is, depending on where you're located and how big you are, if you've been taking a derived price from the exchange and you've got a quant or an algo, which is a guy named Bob, and Bob's in the back room and he's changing the pricing a little bit and he says, hey, this isn't Dow. The reality is it's Dow. It's Dow on leverage. And at some point, the exchange is going to come after you. And if you have not signed up, right, for that derived data, you are going to be paying a very expensive bill. And I think one of the silly things is it's not that expensive. You're talking about several $100,000 if you want to have a contract in place to offer this to underlying customers. We also at FXCM, I think a few people, Saxo as well, will also offer this to other retail brokers through effectively an uncontrolled data license for certain products. And when you do that, there's also a fee, and that fee can be anywhere from $8,000 to $22,000 per client. And I think it's just a silly thing to not pay that fee and run that risk. I think everyone should have that in the contract. And James, maybe you have something to add to that.
Yeah, is this coming up more often now in conversations, James?
Whatever you said, I'd rubber stamp it. I mean, you play with the exchanges. I mean, in a former life, I was on the equity side, and I was aware of something that happened at one of the large banks who had been hiding the number of terminals they had. They had been reporting in their monthly reports. The bill was $4 million. So why would you do it? Why would you do it? It's just, it's just dumb. So I think you're on the money.
Is it coming up in conversations more often now? That people
absolutely.
Are asking
I mean, look, when you look inside ADS, we've got compliance, we've got legal, we've got technology team, through Andrew's team, and they just don't give this stuff away. And the question is always asked: are you aware of where this data's come from? Because the minute we send it out, we're liable, and nobody wants to get that bill. Nobody, and you certainly don't want people crawling all over you. So keep yourself clean, and everything's fine.
Okay. Just on the overall trends of CFDs, I just wanted to get some opinions. Are you seeing it becoming, is the panel seeing it becoming more important for Forex brokers? It's a bigger part of the business. Is it more profitable, less profitable? Just maybe Cyril, you can just What trends are you seeing in terms of CFD trading?
Well, definitely, I think Brandon was saying that the most traded instruments remain the indices, and that's for sure. Now, what we see with JFD Prime, maybe 2 years ago, we had a number of brokers that were running, a CFD business. It was virtually not much, compared to what we were doing. These days, we have clients that are European brokers, and we see massive amount of trades on CFDs. There are some days in the month of September or August where we were seeing more volumes on CFDs than on FX. So it's really like a predominant part of the business. I think that when there's less liquidity or volatility, on the FX side, someone who has a good CFD offering will end up with a good result at the end of the month. So I think it's very, very important. CFDs are picking up. Now, if we're talking about the regions, we see, for instance, in South Africa, we've been starting to do business there. There's a major interest in stock CFDs. Namely the local market and also the offshore stock CFDs. We don't see as much volume as in Europe on the indices. So there's a big variety. What matters...
So you're sort of saying it's very important to kind of know your audience and how you're marketing those products to them.
Look, when you're a prime of prime, you want to have a wide range of markets available so that you offer flexibility to your clients. Then after... depending on also the IT, the server capacity, how many CFDs can you integrate into your system, then you'd better know what your clients want, the end clients, and then you can shortlist it.
Okay. Brandon, what do you think?
Yeah, I think for us, are seeing what everyone is seeing, which is, whether it's equities, there's been a massive movement from trading in shares into ETFs and funds, right? In the CFD space, again, the largest broker on the planet touts that 54% of his revenues comes from the index CFDs. In foreign exchange, we've offered 40 to 50 currency pairs for the better part of 15 years, and about 80-85% of the flow comes on the top 4 or 5 currency pairs. So for us, we're trying to stay focused on the stuff that is the most commonly traded, which are again the index CFDs and the FX majors.
Mm-hmm. And Joe, what are you seeing from your broker clients as far as their interest in CFDs?
We get interest. FC Stone doesn't offer CFDs. In the U.S., they're illegal, actually.
Well, you're getting demand for hedging for those products.
And all those clients that are coming in, they're using FX futures, but they're also using the other futures vehicles for their CFDs. So, and we are getting demand. It really is a good crossover to be able to offer both futures and FX in one offering, as well as equities. It really pairs up quite nicely.
Okay, Christian. 2 years ago, when the conference, so I had an interview with Kim Fernandez, and he mentioned that Saxo had gone above 50% for CFDs compared to FX. Is that something that's still taking place, or is that always fluctuating?
Yeah, I think if we look at our entire equity side of the business, that being the CFDs, the cash stocks, and the listed options, it is at par with our spot FX today. So it's grown quite a lot.
And just curious, is there do people come for CFDs and then they'll continue trading CFDs, or do customers like come in one product and then stay with that, or maybe start?
I would say that this panel is about multi-asset, and we got stuck on CFDs and FX. But the interesting thing to remember is that however you draw that client to you, whether that client comes because they're a CFD client, if that client comes to you because they're a foreign exchange client, what happens then is that if you provide the right service, the right product, and that client likes that, then they'll start to ask for more. So you will spread into CFDs. You will then start to do futures, whether it's a service level. I'm just offering futures because I'm offering a service to help you hedge. Then it goes to single stock equities, and the list goes on. So I think from a multi-asset point of view, however that client comes to you in today's world, you've got to be able to, when they decide to diversify their portfolio, you've got to be ready to take advantage of it. So to your question is, it doesn't matter what brings them. When you're fishing for the client, if they come via CFD or they come via FX, you've got to make sure that their next move is on your platform and is on your product.
Okay. You mentioned about servicing clients. Is when a broker is adding different assets, does that also mean that a broker also has to have extra support in order to be dealing with different types of products, or can that FX
No.
salesman then just do CFDs or?
I think that it depends on your sales force. I mean, no matter what, and these guys would appreciate, you've got to have product specialists. You've got to, it's no good, it's no good me. I'm a good car driver, but I probably couldn't get a Formula One car around the track because I couldn't get the tires hot enough. So I'm not an expert in order to do that. If you then look at, if I'm bringing somebody on to talk about CFDs, we hired a team in Abu Dhabi for trading them. Guess what? That's what they do. They're CFD people. They're not foreign exchange guys. We got a separate team for that. But I think that even in the back office and operations, you need specialists. Would you agree, Christian?
Yeah, I think, especially when you go into the listed, the cash products, the single stocks and so forth, it's a massive build out of your back office capabilities. That was at least the learning we had. Moving into like listed derivatives, ETOs and so forth, it's a massive plumbing IT upgrade because we offer 160 spot crosses, but we offer 20,000 listed derivative price points. So the pipes are just growing in order to cater for that.
And then you've got one thing we didn't add in here is compliance
Yeah.
and regulation. There's a whole army of people who deal
we're purposely
with that.
keeping away from that. The first panel had a little bit about regulations.
We can't escape it.
But Ron, I think that it's also important to say that you have to equip your client with the right level of research, multi-asset research, trading tools as well, correlation metrics. You really have to teach them, and that works really, really well. You can attract clients because you have a good FX offering. You start launching CFDs, and you explain to them what are the benefits of trading CFDs, how they can diversify their exposure in the market, where they can find the volatility where it is, and it just works. They end up trading CFDs. The principle of trading a CFD or an FX, it's exactly the same. You can go long, short, whatever. So you equip them with the right tools and the right research, and off you go. It works.
Okay. Brandon, you have something to add?
No, I'm still thinking about clearing. Can we go back to that? I know we started with that. I want to go back to clearing. You let me know when you're ready.
Do we have 3 hours to go? If you do the quick answer about clearing, the quick explanation.
Yeah, I want to, because we mentioned clearing a few times, and it's such a hot topic at the show, and especially this year is, if you look at the tier 1 clearers, again, Citibank or Deutsche Bank, they have a PB unit that is separate from the execution unit, and that is done on purpose. And when you interface with Citibank, let's say PB, they are completely agnostic to who you trade with. So you could have a lineup of bank and non-bank liquidity, and then all those trades clear and settle with Citibank. And similarly, when you go to a prime of prime, and I know, Joe, you guys have been doing this forever at FC Stone, if you're going to be a prime of prime, you should also be agnostic, right? If you're going to offer a clearing service, you're going to offer multiple execution hubs. And that's where I think the word becomes a bit ambiguous because, again, in foreign exchange, because of the market structure that exists, there can be multiple people out there offering a true prime of prime solution. When it comes to something like index CFDs, there is not a prime of prime in the index CFD space. There's someone who's reselling index CFD liquidity. They're offering execution. They're not offering clearing, right? And I think it's a big distinction that I think is important to make because the fee structures are different and what you want in those scenarios are different. And I think definitely for a retail broker, they will struggle if they're not executing through that broker, but they just want to clear through that broker because they're always going to face this challenge of, if you think about it, and sorry, just 1 minute, just 60 seconds here, the retail broker, right, his dream is to increase volumes. As he does that, his net open position continues to increase. And just as that happens, the retail broker wants to call you and lower his commissions. Just as the time when your CFO at your company is coming to you and saying we should be increasing the cost because it's increasing the NOP. And that's why when people are saying prime of prime for, say, a hedge fund or a low latency fund or something like this, It's multiple execution hubs. When we're talking about offering a service to a retail broker, in my mind, it's not really a prime of prime. It's you're selling liquidity and execution.
Okay. Just want to, before we get to the Q&A, Joe, the last question for you. Moving away from retail brokers and CFDs, some of the asset managers and HFT people that you're dealing with, what are the, like, what products are they trading right now?
A lot of the clients that are coming to us, they do want to trade spot FX, but what they're really looking for is options and NDFs.
Can you maybe give a little bit more about what is it about NDFs that interested people?
So first of all, the NDF liquidity since the new SEF rules were put in place has been very limited. Unless you're a swap dealer, which FC Stone's a swap dealer, you can only do a certain amount of NDFs in a year. I think it's 8 billion in a year or something like that, and that includes swaps. It
Yeah, that's
includes
correct.
options.
There's a Bitcoin swap company that's taking advantage of that because they're not going to do 8 billion and they don't need the swap license.
Well, that's exactly right. Well, I'm sure they'll track them down as well. But the ability to offer these products has been a big leg up for FC Stone because, as you were saying, some of these guys that are offering quote-unquote prime of prime offerings, they're actually just reselling the liquidity they're getting. They're not prime of prime. They're calling themselves that because it's convenient.
So these funds and traders that are getting to you for like NDFs, is it specifically because they can't find that liquidity elsewhere, or is there like an opportunity that they're seeing in NDFs that they want to?
I think it's an opportunity for us in a lot of ways.
On the side of the trader, not on.
Well, it's an opportunity because they were clearing. Most of these guys just ended relationships with Citibank or Morgan Stanley or B of A. Like there's a whole line of people dropping out of the PB space. So as a prime of prime, and we consider ourselves a pure prime of prime, and we don't care where the client trades. It's we'll give them whatever access they want. This appeals to them. This is as close as they're going to get to replicating their prime brokerage offering. And the fact that we've got swaps, NDFs, and options in-house, it makes it very appealing.
Sure. Okay. Let's open up to questions. Anyone have questions? Who has a? Erez, you bring the mic around.
I was just going to ask you guys that we've seen. What's your view about the banks that obviously a load of banks have withdrawn, but there appear to be some signs now that some of the maybe not tier one top of the range banks, but some of the smaller banks are now coming back into the prime brokerage space. Do you see any evidence of that? And what do you think? Will that space actually be refilled by new competition as we go down, as we go along?
I honestly would be surprised by that if we see that as a trend. Just from what I was saying earlier, a few years ago, shareholders were already getting a little bit antsy on the returns they were seeing in exchange for the capital that the banks had. Now increased regulations are there, and so the capital that the bank needs to run the same business is increasing, right? And so now they want to go and raise more capital, and the shareholders sitting there saying, wait a minute, you want to dilute me to make what's going to be, in a ratio sense, less of a return. And so for foreign exchange specifically, I think that this whole credit crunch is only starting. And I would not be surprised at all if entire FXPBs don't go away at a banking level, certainly at the tier 2 banks, would be my guess.
I think it also opens up new markets or new people to enter the market, like, for example, ADS, Saxo, others, because our balance sheets allow us the depth to do that. So we can actually start to utilize our capital and our ability to offer that service down. It's going to drive things like principal trading to be at the fore. We can give credit lines. We can start to use that wisely. Nowadays, the whole concept of cross-netting across assets as well. So netting across multiple assets is going to be an important thing. I think, Brendan, your point about the regulation and the credit crunch, compliance don't want to touch that. So you have to be more nimble and you've got to be more innovative. And I think that's something like the ADS can do for a little plug for our company, we're working on that. That's the stuff. But it's not easy. These things, there's a lot of credit control, there's a lot of risk committees, there's a lot of things that need to happen. But we should utilize the fact that we have a monster balance sheet and, let's use capital wisely.
The mentioning of smaller banks getting into the space, I discount it completely, just because just the rate of return and the cost infrastructure, even to build up, you have to build up Triana, you have to have a risk mechanism, you have to have the ability to track collateral. It's a big undertaking. I think if you're not doing this business now, it's very unlikely that smaller banks will be doing this, because they also have smaller balance sheets and they have less capital to go around for this low return.
Okay. Next question.
Thank you. This question is for Christian. Christian, can you give us an idea on how significant, in terms of numbers of clients that start on something like physical stocks and migrate to stock CFDs or vice versa?
Yeah, I think it depends a lot, and it depends for a number of reasons. Some of them are geographical, and some of them are Salesforce talent, so to speak. There's also some various regulatory reasons. But it used to be, if we go back, we had our first CFD, I don't know, 12 years, 13 years ago. It used to come from cash stocks to CFDs. It is still the normal journey for a traditional investor to go invest in cash stocks and then move on to CFDs, single stocks, maybe some indices and so forth. But I think it's changing slightly, that it's not the normal path all the time. But what we do find is that cross-collateralization between having the cash stock, let's say you buy some Apple stock, you put that in your account and you use that for collateral for your CFD margin trading. So you don't have to actually put money with Saxo. You can just put liquid stocks or bonds. That's a very strong trend in the market, and something we spend a lot of time making sure that our margin engine can cater for.
Thank you. Any other questions? No, it's right before you.
Hello, Andrea from from CardPay. I'm so sorry. I have a question regarding the trends on the multi-assets, on different assets. So are you seeing any kind of trend on your traders that want to start trading physical precious metals like gold, silver, etc.? Because you all have different kind of products, but I haven't heard anything about physical precious metals. Thank you.
When you say physical,
physical
are you
delivery,
asking for physical delivery, or are you talking about book entry?
Well, I'm talking about all those traders that... Thank you. I'm talking about all those traders that don't feel like buying gold, like not being physical. So literally moving gold or silver from a vault to another vault and stocking it in there. There are many brokers nowadays that are getting these kind of services because they see a need, especially in the Middle East, and I know some of you are targeting Middle East quite heavily. So
FC Stone has a physical gold, actually precious metals business for physical delivery. When you start talking about that kind of business, you're talking about transport, warehousing, cities of delivery. It's definitely not. It definitely wouldn't fall into like a CFD category, and it's also very credit-based, because between the time the deal is done and the time the deal is settled, you're basically extending credit for the full amount of that trade. So we're definitely having great demand for that product, but it's only scalable to the amount of credit that can be offered.
I would say that ADS actually has a gold delivery service. We are, in precious metals, we are very aggressive, particularly in the Middle East.
Which maybe you can add a little bit more on what she's answering, like which countries is beyond Middle East is there also demand for that?
Well, the man sitting over there, Turkey, India, so Hong Kong. So, and that's a very big business for us, where the client will trade all week, and then at the end of the week, they send you a delivery notice, and you've got to go and, as you said, you've got to phone Binks get it delivered, make sure the security people are there, make sure the ink's in the bag. It's a fairly big undertaking, and it's not simple to do. It's taken us a while to get it right, but it is now up and running, so we can do it. But it's not it's a specific market. It's not a mass market, so it's specific, and your list of clients, is a bit smaller, but when they trade, they trade well.
Just adding on what you said, is there a high margin type of product, or not really?
No, not at all. By the time you take off all the costs.
Well, yeah, it looks like it's high margin at the time of the execution because you have to tack on transportation, warehousing, insurance, security. There's a whole bunch of stuff that goes once you're delivering physical metal. It's costly.
And then it gets competitive because you'll get people fighting over the transport costs. Oh, I can get the transport cost for X dollars cheaper. Really?
Okay. Next question.
Hi there. Quick question. Just how worthwhile is it to have infrastructure that supports, 50,000 instruments or whatever it is, when all of you guys have mentioned that the majority of, whether it be retail or whoever it is, trade a handful of instruments? It's like, I think, James, you were saying, you drive a Ferrari, but you wouldn't be able to drive a F1 car around the track. Similar scenario, it's like buying a Ferrari and driving it through London in peak hour traffic. You're not really, it's nice to have, but you're not really maximizing the use, right? So how worthwhile is it to have all of these instruments?
So you go into a donut shop and you want to get a donut. If they don't have your favourite, the strawberry one, but they've got everything else, then you don't buy from that shop. Unfortunately, it's the nature of the business that you have to be able to provide a massive amount of data for your client to come in and choose it. And that's just the nature of the business, because you never know when, you've got the universe of stuff that will be traded, of instruments, and you never know which ones they're going to take. Would you agree with that?
Yeah, I think if you compare it to the FX business where you have the majors very concentrated on the volumes on the majors, you will find on the CFDs that, the broker in Poland and his clients, they will trade the Polish exchange plus UK, US. The guys in Italy will trade the Italian market and UK and US. So it's not just concentrated around the products, but really it has to do with where you are in the world.
Okay. What do you believe, Cyril?
No, I completely agree. I mean, depending on which type of business you are, if you're a retail broker and you're addressing a retail client base that is localized somewhere, you have to understand their needs and, work around it. There's no need to have 20,000 instruments. Here, we're also providing an institutional service to other brokers. So obviously, we'll have clients coming from all over the world with different requirements. So it makes sense for us to have this wide variety of instruments. I think in addition to the multi-asset class, what comes with it is the services that you can offer. We're discussing, and I'll jump in, for the asset managers, they may come to brokers or prime brokers because they want to have a full service. This means a regulatory umbrella, for instance, vehicles where they can distribute their strategies, so certificates, alternative investment funds, ETFs, or managed accounts. They want to have a good PMS service, like a multi-account manager. All this comes together, and I think that we understand this business, and we have the capacity to support all these emerging asset managers with this type of services. So it's a full package, really.
Okay. Just one last follow-up question on what was asked, because we're running out of time right now. So do you guys believe that this is the end of the single asset broker and you have to be a multi-asset company to survive, or is there still potential to be a single asset? Just a quicker answer from everyone. Start with you, Christian.
Yeah, we in fact made that decision many years ago to go multi-asset, and of course the danger is that you end up in a situation where you're a jack of all trades, master of none, and you need to be careful about that and manage your expansion into the other asset classes carefully.
Okay, Joe.
I think if you're offering just one product, these products are cyclical. And if your product is doing poorly and it is in a downtrend, you're leaving a huge opportunity by not having these other assets. Also, I think a couple of the guys said on the panel, they come for the FX, but they stay for the CFDs or the futures. I mean, you have to invite people in to be a customer of the firm, and then you have to be responsive to what those clients need.
Okay, Brandon?
Yeah, I think it's a complicated question, and I wish I had more time to answer it. But the short answer would be I don't think so. I think that we'll use Saxo. They've got a truly multi-asset platform with lots of stuff. Very difficult to replicate that. This is not something that happened overnight. It takes years and years and years to build something like that. Similarly, at FXCM, while we don't have certainly 20,000 products, on the FX side, when I talked about the stat of 550,000 trades a day, it's because what we gave up and what we saw as kind of the product war, we examine in terms of the performance war on a much smaller scope of products, and that caters to customers that we win. But there's also some customers who obviously we don't win, and we certainly lose to a multi-asset broker. It's a complicated world out there.
I think personally that it's very important to have a multi-asset class offering from a marketing perspective for sure, but from a risk management for your clients and yourself as a broker and your prime broker, it's super important. We've seen with the SNB event that companies that had a limited number of instruments had a massive exposure from their client side, and it led into problems. I think FXCM, you were hit by that as well. We have 9 asset classes across 850.
Come on now. That's, I don't think January 15th doesn't happen if we had 20,000 products.
Well, we had only 0.3% of our client exposure on the Swiss franc.
You don't hold the same FX exposure that we do. You're not doing 15 yards a day. But we'll leave that there.
Okay.
Okay, that's my point of view.
So
you can clap it up for him,
I didn't say anything, sorry. Look, multi-asset, we'd all love to have a fantastic multi-asset platform, but you've got to be smart behind it. Let's ask why we get into that. Number one, we get into multi-asset because it's clients driving us that way, but you've got to be smart about getting into it. If you just build everything and deliver nothing, there's no point to that. So I think what you do to answer that question is that, first of all, you do what you do well, very well. So whatever your foundation is on your house, that's the most important thing. Then you build on it, but you build by your client demand. So if your clients want to go CFDs first, or stock, or futures, or the list goes on, then you follow that. So I believe that it has to be multi-asset, but at the pace that your clients drag you there, not because everybody else in the market is doing it.
Okay. Thank you very much. Thank you, everybody, for being part of this.
Everybody.